Welcome to the 2024 Black Swan event. This is actually the second Black Swan event of this year. The first one was the yen carry trade blow up on August 5th. But today can definitely be characterized as another Black Swan event. And here in this video, I will discuss exactly why that is. The reason this can be categorized as a Black Swan event is because nobody expected this to happen. Literally nobody expected this. I mean, look at the VIX today. Wow. I mean, the VIX up 74%. Nobody had puts heading into today. Nobody expected what Powell gave us. And that's why this is a Black Swan event. It caught everyone off guard. And really the bottom line to this is nobody was expecting things were really going to change, okay? We were kind of expecting the dot plot would the Fed would move up their expectations for growth. They would keep steady their expectations for the unemployment rate. We were expecting that, the amount of cuts next year would be between 2 and 3, and that actually happened. But Powell during the press conference sounded like they were done cutting rates. So the markets were not expecting that the Fed easing cycle was over with. And that's essentially where we are now. It sounds like the Fed's easing cycle is over. It actually sounds like the Fed could be setting us up for an eventual rate hike. And that's part of the Black Swan nature of today. Nobody was expecting that this was the end to the Fed's cutting cycle. Okay? And that's kind of where it seems like we are at. So this is a problem heading into 2025 with valuations the way they are. I've said many times here on this channel that valuations do not matter until something changes. And something changed today because Wall Street was expecting we were going to get a couple more cuts, kind of make our way to about 3%. And now it appears like that is not going to be the case. Okay, so that is very problematic. It's harder to support current market valuations without any more cuts from the Fed. Now, one of the other issues with today and with the speech from Fed Jerome Powell is the fact that Fed officials are actually taking into consideration potential Trump tariff policies before they are even enacted, right? We don't have any Trump tariff policies that have actually been enacted, but yet the Fed's saying these tariff policies are going to be pretty inflationary. And they're trying to get ahead of that now, which is something at the last meeting the Fed said they were not going to do. Fed Jerome Powell explicitly said at the last Fed meeting that they were not going to jump to conclusions of what, Trump tariff policies will be or how they will affect the inflation outlook. Instead, that's exactly what the Fed did today. And that is why today is really a Black Swan, because nobody was expecting that. Do you know what people were expecting out of today? Nothing. People were expecting this was going to be a kick the can down the road kind of Fed meeting. Okay? No. Powell changed everything today. Now, this comes at a time in which the markets internally have already been weak. I mean, the Dow was already down 9 days in a row. And today is now the 10th day in a row. This is the worst losing streak since 1974. I said in the last video, as long as nothing changes, then we were probably going to rally in markets because we were already very weak heading into today. But something changed, and that's why markets reacted so negatively. And now, from a technical perspective, we are in a pretty weird area. We've fallen below the 50-day moving average. The next stop could very well be that 100-day moving average down here at about 572. Today, here in after hours, S&P's at 586. That would still be quite a bit of downside from current levels. Now, keep in mind what happened in 2018 in December. The markets absolutely crashed into the end of this year. They bottomed Christmas Eve. Some of that had to do with the 2018 Fed meeting that also occurred in December. The Fed spooked markets then and caused an end of the year crash. And there's a lot of people that are starting to say that that could soon be the case again. And to get down to this 100-day moving average would be a fall of about 2.3% from current levels. Indeed, Powell delivered the unexpected to markets. This was on nobody's bingo card for today from the Fed. And considering we already kind of have an understanding of what this could mean, like here, Zero Hedge says the Fed's easing cycle is over. Like it is. That's what Powell was really conveying today, is as long as the economy continues to perform in line with expectations, the Fed easing cycle is over. It also creates another issue because Powell was asked today, and I'll paraphrase here. He said, he was asked, what makes this time different compared to July when the unemployment rate was roughly where it is today and people were concerned about growth? And Powell basically avoided that and said, we think the economy is going to be strong. So it creates another issue, a potential policy error issue, meaning if we are, going to slow further from here, if the unemployment rate is going to rise further from here, the Fed is only going to respond to that. That's what is going to get the Fed to cut rates. And that's a bad, place to be, right? Because, the economy weakening is not good for stocks. Rate cuts, yeah, sure, that can be positive for markets. But if we go into some kind of recession because the Fed took their foot off the cutting gas pedal, then that could be a lot of damage to markets. So it's a little bit too early to say now, but we could be back into some kind of environment where bad data is now good for the markets. Or we could be in some kind of environment where everything's bad for the markets. Okay? As far as data, too good of data is bad for the markets, too bad of data is, bad for the markets. It's hard to say at this point, but there's a couple things we know that are clear. The Fed is concerned about inflation. The Fed is not going to be cutting rates from this point going forward unless something changes, unless the economy gets worse or the labor market gets worse. Those are not supportive backdrops to markets. Just heading into this Fed meeting, a lot of Wall Street was saying, hey, we may be 50% done with this cutting cycle, and then, the Fed will pause. Wall Street's kind of been trading around that narrative, that as long as the Fed is cutting rates and the economy is strong, bull market is alive. Well, now it's like the Fed's done cutting rates, economy's good, but what does that mean for the bull market? What is there to really hold these valuations to where they are, especially if long duration yields do not fall, if short duration yields continue to kind of stay where they are. Okay, look at bond yields today, back to 4.5%, up 12 basis points today. So this was a big blow to markets. This was a big blow to expectations next year because people thought we were going to get at least 2 to 3 more cuts next year. And although the dot plot says that we're going to get 2 cuts next year, Jerome Powell made it sound like they won't be cutting rates unless they see progress on inflation or unless the economy weakens. And given the last 2 months of, CPI and PPI reports have come in on the hotter side, that's just not comforting for markets right now. And that's where the issue comes in because markets have rallied a lot. Okay, markets were not just like trading sideways or down into this Fed meeting. Markets were sitting near all-time highs. And the fact that you've seen the markets internally kind of crumble recently, and big tech, a handful of stocks have kind of held the markets higher. If now you see those names start to give back today, like you've seen with Nvidia and all of your big tech names, I mean, look at Tesla down over 10% today. I mean, that could create some rapid downside in markets because you don't have a broad, healthy market. Things have been getting bad into this Fed meeting, and now they just got a lot worse. Now, I certainly don't want to count this market out indefinitely. There still is a chance that we could recover, that the markets kind of have short-term memory and they forget about this over the coming days, and we revert back to kind of the Santa Claus rally, end of the year kind of rally. But with valuations the way they are, that just seems a little bit more difficult after the change that we got from Powell today. I was, again, under the assumption that nothing was really going to change today. That as long as nothing changed today, then we could rally. And it just becomes a little bit harder, or I would say a lot harder for that to happen because something did change today. The Fed is obviously concerned about inflation. And now you're getting some folks on Wall Street that are becoming concerned that you could actually see the Fed raise rates next year. Or if inflation goes up again for another 2 meetings or so, we could be talking about raising rates by March, and mix that with Trump policies for tariffs, assuming that's, somewhat inflationary. You could be in a really bad scenario a couple of months from now. And Wall Street has to kind of readjust their expectations around this like that. And that's why you've seen the S&P that closed down over 3% today. I don't leave this out or anything, but Jerome Powell also made some very conflicting statements about the labor market. He said the labor market is essentially weaker now than where it was in 2019, but he also said the economy is going to do just fine. There was some very conflicting things today. The narrative was not clear, and that led the markets to a lot of speculation. Again, as I said throughout this video, this almost feels like Jerome Powell's warming up the markets to potentially no cuts at all, or in a more worst case scenario, opening the markets up for a pivot to actually raising rates. Now, I think raising rates from here would take some high inflation numbers. It would take probably a very strong economy, some expectations of higher inflation, right? It would take a lot to actually get the Fed, I think, at this point, to raise rates. But the markets are kind of jumping to a lot of different conclusions right now. And this maybe wouldn't have been as bad if markets were lower, right? We were just at all-time highs. I mean, now we're not, okay? From all-time highs till now, we're down about 3.69%. So we're not down much from the highs. And honestly, you probably need to flush out some of the optimism as is, okay? And I said this before the Fed meeting. The markets were not euphoric. The markets are not super bullish. But the commentary around markets was super bullish, with the average expectation that the S&P would be about 6,600 by the end of next year, that we will achieve a soft landing, and the Fed would cut rates around 3 to 4 times. Instead, we got a Fed that sounds a little delusional, some conflicting statements, what sounds like no cuts until we see more further progress, or even, opening the door to a potential rate hike down the line. We got a Fed that acknowledges the economy's slowing. In fact, Jerome Powell, and the labor market for that matter, in fact, Jerome Powell said that the job creation rate is slower than the rate in which people are entering the workforce, so that in and of itself will drive unemployment up. Like, that's not good. I mean, Jerome Powell said the labor market is weaker than where it was in 2019. And we even had a growth scare in 2019. Okay, people thought that maybe we were entering into a recession then. And now we're just like, what the hell? Because we were not expecting any of that. And that's why today was a black swan. Now, We have some precedents for this. In 2018 at the Fed meeting, it kind of set the markets up for some aggressive downside at that time. We did see the markets fall a lot into Christmas Eve. Now, that could happen again. And honestly, I would be shocked if we don't get further downside from here. This was such a slap in the face. This was such a black swan event from that perspective. I think the markets really need to recalibrate expectations. Now, everything may not go down equally. I will point out again, the RSP, the equal weight S&P, value stocks, the Dow. The Dow is down 10 days in a row, the worst losing streak since almost 1960s. Okay, since like 1974 or so. If tomorrow is another red day, I believe that's going to get pushed to the 1960s. Okay, we've had a lot of bad days in a row for certain areas. Other areas, not so much. Like Apple, that's sitting still near an all-time high. Meta, Amazon, Microsoft, Google, Nvidia, they've all done exceptionally well. In really the last couple of weeks, you've seen this rotation back into big tech, and perhaps if we are going to get more downside for the markets, which I think will probably happen, it may be correct in assuming it could be big tech, because that's where the expectations are the loftiest, and that's where valuations are the loftiest, okay? For really slow growth or no growth companies as is, like Apple's barely growing. I mean, why would you really want to own Apple in the environment in which the Fed's not going to be cutting rates, the unemployment rate is rising, and consumers feel even more stretched? I mean, there's an argument for that. There's an argument that healthcare and value and cyclicals have already fallen a lot, and maybe, just maybe, they could be the first to recover. So basically, you could see the markets do okay, and big tech sells off, and you still drive the indexes lower. You could see everything sell off further. I just think you have more of the sell-off already done in the Dow, in the Russell, okay, in your cyclical and industrials and healthcare names, whereas you haven't seen much selling at all, besides today, in some of your big tech companies that are here on screen. So if I were to give my best guess on what's coming next, it is probably further downside, but disproportionate downside if I, just try to logically think about markets. Now, throughout the rest of this week, we do have some data coming out tomorrow morning. We have initial jobless claims at 8:30 in the morning. Considering the Fed today, I think that's going to be an even bigger catalyst. If the economy weakens, if this number comes in high, is that good or is that bad? I don't know. Okay, we have a lot of secondary data, existing home sales, Philly Fed data, Kansas Fed data, as well as the inflation rate out of Japan that comes out tomorrow. And then on Friday, you have PCE. Judging off of what Powell said today, it sounds like PCE is going to come in on the hot side because he was so hawkish. But, anything's possible, so keep your eyes out for that one. Personal income month over month, as well as personal spending month over month, will be coming out on Friday also. So still some catalyst left here. But, today, very much a black swan. And then tomorrow in after hours, you will have Nike as well as FedEx that will report earnings. And FedEx is seen as kind of a bellwether for the economy. So FedEx earnings specifically will be important. Micron earnings today in after hours, disappointed, stock down over 10%. And that definitely did not help markets sentiment at all. That is an over $100 billion company. So it's not terribly small. It's not super large as well, but definitely a sizable mid cap, I would say, these days. So that is it, guys. Let me know what you think about this information down below in the comment section. Jerome Powell may have canceled the Santa Claus rally after all. The markets were caught off guard, and it's hard to recover from that quickly when it does happen. So let me know what you guys think, again, down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.